The week we're about to leave behind us tended to move in a rather easygoing mood, yet the coming week may start swinging the markets. On the monetary front, a number of policymakers from various central banks are scheduled to make statements throughout the coming week, which could sway the market's mood. As for financial releases, we make a start on Monday with the release of Switzerland's CPI rates for January. On Tuesday, we get Japan's GDP rate for Q4, UK's employment data for December, Norway's and Eurozone's GDP rates for Q4, while the highlight of the day is expected to be the US CPI rates for January. On Wednesday, we get UK CPI rates for January, Eurozone's industrial production for December, and the US retail sales growth rate for January. On Thursday, we note from Japan the release of the trade data for January and the machinery orders growth rate for December, while from Australia, we get January's employment data, and in the American session from the US, we note the release of the Philly Fed Business Index for February, the weekly initial jobless claims figure, and January's PPI rates. Finally, on an easygoing Friday, we note the release of the UK retail sales growth rate for January. The USD is about to end the week lower than Monday against its counterparts. On the monetary front, we note that we had a number of Fed policymakers making some hawkish comments, more or less increasing market worries for possible over-tightening of the Fed's monetary policy. Characteristically, Minneapolis Fed President Kashkari once again declared his resolve that the Fed's fund rate needs to rise further as high as 5.4%, and if the data support this, maybe even further. That's why on a macroeconomic level, we highlight the release of the US CPI rates for January on Tuesday, and should the rate slow down even further, that could indicate exactly that the monetary policy tightening of the Fed has worked and may ease market worries for a possible extravagant tightening by the bank. On a fundamental level, the challenge to Republicans to raise the debt ceiling included in President Biden's State of the Union speech, and his at some points competitive tone tended to make a sensation. Should the debt ceiling rise, that would allow for Biden's government to actually expand its fiscal policy further, yet that may risk inflationary pressures in the US economy. The pound is about to end the week stronger against the US dollar and the euro, but not JPY. On a macroeconomic level, we note the contraction of economic activity in the construction sector, which could be related, if not caused, by BOE's monetary policy tightening. Yet the worrying part came on Friday, as the GDP rate on a month-to-month level dropped deep into the negatives, displaying a contraction of the economy for December, while for Q4 on a year-on-year level slowed down. Yet another major issue tormenting the UK is the cost of living crisis. Hence, we expect the release of UK CPI rates for January to be in the epicenter of attention for GBP traders in the coming week. The release is also to be complemented by UK's December employment data and January's retail sales, and could create some volatility for GBP pairs. On the monetary front, we note a number of BOE policymakers such as BOE Governor Andrew Bailey and MPC member Catherine Mann made some hawkish comments, which showcase the bank's determination to proceed with more rate hikes. Hence, we expect that on a monetary policy level, the pound may remain supported. JPY is about to end the week stronger against the US dollar, the euro and GBP in a sign of a broader strength. On a monetary level, the main issue being discussed is the success of BOJ Governor Haruhiko Kuroda, after a report surfaced by Nikkei.com that BOJ Deputy Governor Mamiya is to be the one earlier this week. The report was not confirmed by the Japanese government, yet the Deputy Governor is considered to be a dove among BOJ policymakers and would be expected to continue Governor Kuroda's ultra-loose monetary policy. Yet there are also other candidates being mentioned by the media, among which former BOJ Deputy Governor Mr. Hiroshi Nagaso and former BOJ Deputy Governor Hirohide Yamaguchi, which is considered a more hawkish choice, as he is considered a vocal critic of current BOJ Governor Kuroda. Also, early on Friday, Nikkei.com report stated that Mr. Mamiya was approached by the Japanese government, yet refused, and that former BOJ policy board member and economist Kazuo Ueda is being considered as the next governor of BOJ. In any case, should the Japanese government choose a more hawkish choice, we may see the market's expectations for the first rate hike of the bank since 2006 rising. The common currency seems to be edging lower against the US dollar for the week, but is also losing ground clearly against the JPY and GBP in a sign of a broader weakness. On a macroeconomic level, we note that the main release of the week may have been Germany's preliminary HICP for January. The results pointed out that inflationary pressures in the German economy eased more than expected, reaching as low as 9.2% year-on-year, and the deceleration may ease ECB's hawkishness somewhat. Yet, we have to note that on a monetary level, ECB Vice President de Guido's comments maintained a clear hawkish tone. The ECB Vice President stated in an interview that I would not rule out that there will be further interest rate hikes after March. The fight against inflation is not won. The statement further showcased ECB's hawkishness and determination to fight inflationary pressures in the Eurozone and raised speculation that the bank may be about to lead monetary policy tightening in an overdrive. On the other hand, ECB's monetary policy tightening continues to threaten the Eurozone with the risk of a recession. That's why the release of the second estimate of the GDP rate is expected to be closely monitored next week. AUD is about to end the week stronger against the US dollar, and RBA's rate hike contributed to the strengthening of the Aussie on Tuesday. The bank, as was widely expected, hiked rates by 25 basis points, and the bank had the confidence to signal more rate hikes to come. The bank's worries for the inflationary pressures in the Australian economy seem to be intensifying, and at the same time, there is confidence in the Australian employment market. Overall, we see the case for the hawkish stance of the bank to continue to support on the monetary level the Aussie, yet traders should remain also vigilant about China's fundamentals and reopening. Yet we note the US-Sino diplomatic tensions that seem to be on the rise, which the Chinese balloon incident being characteristic. As for financial releases next week, we highlight Australia's employment data for January to come under the market scrutiny. Should the employment change figure return to the positives, hopefully pushing the unemployment rate to tick down, that would imply a rather tight employment market that could support more rate hikes from RBA and thus provide support to the Aussie. North of the US border, the CAD is about to end the week lower against the US dollar. At this point, we would like to note that Canada's employment data for January are still to be released and could alter the loonie's direction. On a macroeconomic level, the widening of the trade deficit did not seem to be a major fact of concern. Oil prices were on the rise, with traders encouraged by expectations for increased demand from China, which could allow prices to rise even further, reflecting the positive effect also the CAD, given that Canada is a major oil-producing country. On a fundamental level, we continue to point towards the positive correlation between the CAD and oil prices. On the monetary front, the loonie may have found additional support as BOC Governor Tiff McClem made some hawkish comments as he was reported stating that the bank is prepared to raise its policy rate further. He also seemed to be quite confident that the bank is not to cut rates anytime soon, and that tends to showcase the bank's hawkishness as well. Overall, given the absence of high-impact financial releases in the coming week, we expect the fundamentals to take the lead regarding the loonie's direction. Overall, and as a general comment, we note that the number of high-impact financial releases from the US is about to increase in the coming week, and thus could provide the opportunity for the greenback to retake the initiative over the currencies and lead the markets. Hence, we may see the blend of trading opportunities shifting towards the US dollar. Also, we note that US stock markets seem to remain relatively unchanged. It's as if US stock markets maintain a wait-and-see position. Also, US stock markets are still being affected by the earnings season. In the coming week, we note on Tuesday the release of Coca-Cola and Airbnb's earnings releases. On Wednesday, we note the earnings reports of Cisco, Equinix, and AEG. And on Friday of Daimler. Definitely, we must also note that US stock market participants are also closely monitoring the Fed, and Fed policymakers that are scheduled to make statements could alter US stock market's direction, while the release of the US CPI rates could also have a ripple effect on US stock markets. On the other hand, we must note that gold's prices seem about to end the week in the greens, and more or less seems to take advantage of USD's relative inactivity, or weakness if you prefer. We expect the negative correlation of gold's price against the US dollar to be maintained, with the release of the US CPI rates for January possibly being the highlight of the week. We hope that you found this report useful, and from all of us here at IronFX, best wishes for solid trading.
everyone. The term risk-off refers to the mood of traders and investors in the financial market when they want to avoid risk exposure and safeguard their funds. When traders are pessimistic about the economic outlook, they tend to sell risky assets and buy safe haven assets. In such an environment, safe haven assets like the Japanese yen and gold tend to gain in value, while high-risk assets like stocks and commodities tend to decline. Markets are frequently labeled as risk-on or risk-off. Both of them express global market sentiment. Risk-on, risk-off is frequently abbreviated as RORO. This happens when price behavior is driven by investors and traders' changes in their risk tolerance. When traders are not optimistic, then they tend to reduce leverage, selling risky assets and buying safer assets, or even preferring cash. US Treasuries and German bonds are considered almost risk-free. They rally when traders want safety during times of uncertainty. The price of gold usually increases and the yield on government bonds falls. Thank you so much for watching us today, guys. Stay tuned. Bye-bye.
Hey guys, hi. Hey, hi guys, can you hear me? Can you guys hear me? Mic test, can you guys hear me? So let me open the chat. Question and answer. Hey guys, hello, hello. Hi, Eric. Hi, Mabata. Mic test. Hi there, mic test. Okay. Let's give it a moment for for the others to join before we begin this webinar. you.